Let's start with the big picture. This is probably one of these times it's always like this. There's just so many undercurrents in the market. The big picture doesn't probably properly reflect what's going on. But what do you see?
So I'd say, first of all, we've come a long way from 2022. If you just go back a couple of years ago, we had the biggest increase and the fastest increase in interest rates in 40 years, driven by the biggest increase in inflation in 40 years, driven by arguably the biggest monetary and fiscal stimulus ever. So there's a lot going on in 2022. The risk at the time was, can central banks bring inflation under control fast enough without breaking the economy? Lots of people worried that you'd have to keep interest rates elevated and ultimately break the labor market and break the overall economy. The good news, here we are 2-3 years later, it looks like they've mostly pulled that off. We've been able to bring inflation not all the way to 2, but into a much more comfortable level. The glide path into 26 and 27 looks like we should get back on track fairly quickly. And more importantly, we've been able to bring inflation under control without hurting the labor market, which historically is very unusual. Normally there'd be a lot more unemployment than what we saw in this cycle. And even more interesting, unemployment rates have gone up in a lot of major developed market economies. Canada from 5.5 to 7, for example. But it's not really because people are losing their jobs. We're actually still creating new jobs. The issue is we've had a lot of immigration, and there's just been a challenge of finding new jobs for everybody who's come into the economies. And so the challenge here is with high interest rates, high inflation, it's going to stall that rate of job creation. With interest rates back to a neutral level, hopefully we can keep the labor market intact. And then when you start thinking about 2026, a lot of the benefits from the One Big Beautiful Bill Act that was passed in the summer, they don't really kick in until next year. And I think that's maybe a little bit misunderstood. The bill is passed, everything's authorized and approved, and then you get into next year, and around April, you're going to start to see a lot bigger tax refunds than people perhaps are expecting. Companies start to get a lot of rebates on their capex. And so that's going to be very helpful from an economic stimulus perspective next year. I think the more interesting question is going to be, the economy looks like it's fine. Is the equity market maybe getting a little too ahead of it? So I think the way to think about the market environment right now is economy should be fine. We've pushed a lot of the downside risks out a few years. And then the question is, have the equity markets really gotten perhaps a little ahead of the curve on pricing these things in?
Can you answer that question?
Well, I wish I could. And I think the best answer to that is, we know corrections happen. That's a normal part of the equity markets. We don't know when, and we don't know by how much. And so that's the challenge. If you're to look at things like broader equity market valuations, the S&P 500, we're starting to hear the bubble word tossed around by a few people. S&P 500 is trading at about 22 times earnings today. That's nowhere near the 40 times that you saw in the dot-com bubble. We're well below those levels. But if you exclude the dot-com bubble, 22 times is basically the highest valuations that you'd seen outside of that time period. So markets are certainly pricing in high expectations. And if you look at earnings growth expectations in the market right now, just what is consensus pricing in? We expect, I guess the typical long-term average earnings growth is around 6% for the S&P 500. Consensus is looking for 15% each year for the next 2 years. So double, maybe even triple the normal rate of earnings growth. As long as companies deliver, everything's fine. These valuations are defendable if that earnings growth materializes and if companies meet expectations. And so far this year, they have. Every quarter that we've seen, and particularly the last 2 or 3, meeting expectations or even giving increased guidance. So the tone from companies is becoming fairly positive. But that means the bar gets higher. It gets a little bit harder to beat every time. And we just don't know. We don't know if at some point in 26 or 27, you start to see companies have maybe gone a little too far, a little too optimistic. And that'll be the big risk for markets, is if you do start to see a slowdown and companies can't beat these very lofty expectations.
How do you, I guess, well, so what do you do? So you, again, no one can tell when the next downturn happens. No one can tell the magnitude of what's going to happen. But it sounds a bit like a motherhood statement to say diversify, but it's true. Like in the long term, that is the only thing that can guard against these types of things in the long term.
Exactly, and everybody thinks they can sell at the top and buy in at the bottom and market time, but and there are a handful of people that have done that successfully over time. But for the vast majority of investors, having a diversified portfolio is what helps you when you're going through these periods. You're not going to be caught off guard. You've got one side of the portfolio maybe going down, another side is stable or going up in an ideal scenario, and it gives you the ability then, if markets are off 20% on the equity side, if you can sell down some fixed income and rotate, take advantage. You don't have that if you go in at 100% equities into these. So making sure you have that properly structured, diversified portfolio really helps out in these periods to then take advantage of that dislocation. If you look at the last 25 years, probably the best way to diversify a portfolio is, if you're starting with equities, is to add bonds. The returns are a little bit lower, but they are very uncorrelated with the broader equity market, a lot less volatile. And what we've seen is quite often when equities are selling off, bonds are actually rallying and going up in price. So that is a great diversifier. But the other option, if you're looking at just the equity sleeve in the portfolio, is to look for sectors or strategies that are uncorrelated with the broader equity markets, and which is increasingly large cap tech.
Yeah, and I think I was even going to pose the question, because I know people who, maybe a bit younger than me, they've been on the wave of the Mag 7, have done really, really well, but it's like, and now what? And so when you say diversify, it's, not everything has to happen right at once. There might be things that might be more interesting at this particular time from a diversification standpoint than others. So what would those be? So
the few that we've been flagging, and this is it's a trend that was going on for quite a while within the Canadian pension funds and a lot of global pension funds, is moving away from equities and bonds and adding real assets. Mm-hmm. So we've started to see, particularly the big Canadian pension funds have 20 to 30% of their portfolios allocated to things like real estate and infrastructure. A big part of that is they are only moderately correlated with broader equity markets. Very little correlation from real estate to big tech. We're seeing a little more on the infrastructure side because, of course, as AI starts to become more prominent, you're actually starting to impact utility companies. A lot of these are, in some ways, a derivative play of AI, so you have to be a little careful. But what we've seen over the course of this year, when markets sold off earlier around March and April, they were down 20%. Infrastructure was basically flat. Real estate down maybe 5 to 6%. And so you get a great diversification benefit in these periods of market turmoil. So I'd say those are probably the two best sectors.
And I was going to say, on those sectors, just full disclosure, you're involved with a couple of ETFs at TDAM that do this.
Exactly. We have a few products, actively managed solutions. One of those products, TGRE, has been around. In fact, both of them have been around for 5 years. TINF is our infrastructure solution. What's unique about that is, one, we have a global focus. So we're not just focusing on Canada or US. It does give you a truly global product. It allows us to move around if one part of the market is becoming more concentrated. And then what's also helpful here is that with an active approach, we can move our exposures around over time. If we're starting to see certain sectors slow down or earnings growth deteriorate, we have the flexibility to adjust exposures. And historically, that's also tended to help in downturns. We can pivot a little more defensively and try to protect some of the portfolio value.
I know you were speaking earlier with my producer, actually. We're talking about another interesting thing to think about at this time specifically is just in the long term. I'm going to paraphrase this and you tell me if it's right or wrong. Given where rates are going, they've been low for longer and now they're probably going to be higher. And then, which companies can withstand that? Who have the strong balance sheets? Who have the strong dividends, the strong yields? And that's a good place to look in the long term.
Exactly. And we've come from an interesting period. Lots of things are changing in markets. If you look at 2010s, capital was basically free. You could borrow money in the debt markets for very low interest rates. Generally companies could access equity if they needed to grow. It's changed a little bit in the last 2 or 3 years with interest rates and inflation. There's a cost of capital again. And that means if you're a company that's growing aggressively and you need capital, if that capital is not there, if the debt market shut down, or if the interest cost is too expensive, or you can't raise equity, there's always a risk in those companies that they need funds at the wrong time and they can't access it. When you look at these environments where interest rates are perhaps a little bit higher than they have been in the past, companies that can self-fund usually are far more resilient than companies that are dependent on external financing. Usually that comes from being profitable, and if you're profitable, usually you have the ability to pay a dividend, and then more importantly, to grow that dividend over time. Dividend investing over the long term has generally outperformed markets by a couple percentage points a year. Not so much last decade because circumstances changed, but we're starting to see that come back in now, where investors are focusing again on yield because interest rates have sort of come off the peak from 2 years ago. But just in general, it's about having resilient companies that, instead of consuming capital, can actually give it back to you. And the track record over decades tends to suggest that the dividend stocks and dividend strategies usually outperform.
Yeah, and I should just mention TQCD is one that TDAM, an ETF that follows that philosophy.
Exactly. It's one that focuses on dividends and also uses a number of different screens to help select within that universe to make sure we're avoiding high payout ratios and so on. So those sorts of strategies are excellent ways of adding some of that exposure to the portfolio.
Jeff, great to have you with us. And a reminder just for, people who are listening also, do your own research and, of course, make sure these things fit for you in terms of what we're doing. Jeff, thanks so much.
Thank you very much.